Today we're going to talk about the merge, the implications it has for users, and some of the secondary effects that we can expect as Ethereum ecosystem participants.
So, Allan, why is it called the merge?
So we're calling it the merge because what's happening is a joining of the execution layer, which is what we traditionally refer to as mainnet, or the Ethereum blockchain at the core, and the beacon chain, which is the consensus layer. So best way to think about it is that today the mainnet, or the future execution layer, is continuing to operate as it always has, right? So it's moving forward, it's approving transactions. The consensus algorithm that's baked into that execution layer, that's baked into mainnet today, is proof of work. Now, in parallel, the beacon chain, which has been live for a little over a year and a half, has also been moving along. The beacon chain also is something that we'll kind of refer to moving forward as the consensus layer. And the consensus layer is where proof of stake lives, for lack of a better term. So what we've been working on over the past, I say we, as in probably Ethereum community, mostly Ethereum Foundation researchers, is getting to a point where we are able to integrate that consensus layer, the beacon chain, on top of the execution layer, or mainnet as we know it today. And what that means is we'll have a kind of a clear separation between execution and consensus whenever the consensus layer and the execution layer merge or meet. So that's what we're excited about. That's what's coming hopefully in September, is the joining of this new proof of stake consensus layer with the existing execution layer, and then the removal of proof of work as the traditional consensus algorithm for mainnet.
So, I mean, you kind of got into it there, but then why would you say that the merge really matters? Why is it such a big deal?
So the merge really matters for a few big reasons. One of the most popular narratives right now is the kind of ESG angle on the merge. So proof of work systems by nature consume a tremendous amount of electricity, especially the biggest proof of work systems, because at the end of the day, it's really just many different machines that are competing to solve a puzzle and beat other machines out. And so, Bitcoin is the biggest consumer of electricity because it's a very large network, and there's a lot of people competing for Bitcoin rewards as miners. And currently, the Ethereum ecosystem is also driven by proof of work mining. With the shift to proof of stake after the merge, we're expecting energy consumption related to mining or validating transactions to fall 99.95%. So there is going to be an exponential drop off in the amount of electricity consumed to maintain the network and ensure security. So that's a really big point of differentiation. Obviously, on a global scale, that's definitely a very important opportunity, I would say, for Ethereum to set itself apart and to also be a little more future focused and sustainable. So the sustainability piece of proof of stake consensus is definitely a big deal. It's also the merge is also a really important stepping stone towards a more scalable Ethereum in the future. Now, right out of the gate, it won't necessarily improve transaction speed or anything like that, but it will, again, kind of like lay the foundation for some of the future Ethereum upgrades like sharding and other sort of scalability solutions that require proof of stake consensus to be enabled. Interestingly enough, one of the reasons that the merge, or this like shift to proof of stake, was moved up in the roadmap a few years ago was because rollups made a lot more progress than people originally expected. So L2s like Optimism, Arbitrum, ZK Sync, a lot of the other ZK rollups that are coming to market soon have made the scalability play a little bit more immediate. And so the shift to proof of stake won't directly affect scalability, but again, it will put us on a path towards a more scalable mainnet, and then ultimately, layer twos and even layer threes at some point.
Okay, well, maybe we should talk about some of the misconceptions that we're seeing going around about the effects that the merge are going to have on the asset, Ethereum, the network. So are gas fees going to go down from this? Or is that what we're going to see from the merge?
Yes, there aren't going to be any material effects to the transaction throughput or gas costs after the merge. So because it's not necessarily one of the upgrades to Ethereum that improves, the scalability piece of the puzzle. It really is more of a stepping stone to get us to a point where we can enable other upgrades that do have an effect on transaction speed and gas costs. So, put another way, it's not going to have any effect on Ethereum users whenever it's implemented. There's kind of secondary effects, and again, future opportunities for gas costs to come down and transaction throughput to go up. But the merge is a building block to get us there.
Is everybody going to sell their ETH as soon as the merge happens?
Yeah, so that's another common misconception about the merge, is that as soon as the merge occurs, anyone that has staked their Ethereum on the Beacon chain can unlock it and do whatever they want with it. Withdrawals for stake these actually aren't going to be available or enabled until the Shanghai update, which is 6 or so months after the merge. Now, when people locked up their ETH, as far ago as like December of 2020, there was definitely a different price then than there is now. So there could be an outcome where whenever people can withdraw after the Shanghai update, that they do. But there are many incentives in place for people to leave their ETH where it is and to continue capturing more of the staking rewards. One of the other misconceptions about the merge is that the staking APR, or the reward that stakers receive, is going to go up exponentially from where it is today. Right now, it's looking more like the APR will probably increase 50% or so. So if we're using kind of 4% as our mark for what the staking reward is right now, it'll likely be 6 to 7% after the merge, and that's not a function of more ETH issuance. That's just a function of the fees associated with all the transactions being directed towards stakers and away from proof of work miners.
Okay. I think that's a great explanation. Is there anything like more general to the merge that you think you'd like to talk about?
Yeah, I think that the merge is also going to have a very material effect on ETH issuance, and that's just a function of the number of new ETH that make their way out on the market every day, and that's largely composed of block rewards. But the overall effect on net issuance for ETH, I think, is supposed to be like 90% reduction. So there's going to be a lot less ETH making its way into the market on a recurring basis compared to what we're used to in a proof of work system. So that's definitely a big change to the kind of economic profile and implications for ETH as an asset. There's also going to be a very material shift for the fees that are paid to miners in a proof of work system that will be paid to validators in a proof of stake system. So that is going to be a really interesting shift to watch. Another kind of nuanced piece of the proof of stake or staking puzzle is that people won't be able to withdraw their rewards until the Shanghai update, which is 6 months plus after the merge. But they will be able to access the staking fees that they receive as a share of transaction fees. So they'll receive more ETH that comes from essentially the gas that people pay with their transactions on top of whatever the kind of baseline staking rate is. So the core deposits to the Beacon chain won't be accessible until after the Shanghai update. But in the interim, people will be able to claim and access any of the transaction fees that are associated with all the blocks they're helping validate.
The supply and demand side of this, with the drop in issuance, is it an oversimplification to say that to maintain equilibrium like we would have to find that selling pressure elsewhere?
Yeah, so don't necessarily have a degree in economics, but my understanding of it is that if you have a very real reduction in supply or issuance of any asset, commodity, widget, whatever, and you expect demand to stay where it is, ceteris paribus, or even increase, then there's going to be a higher price for whatever that asset, commodity, widget happens to be. You can make the case that, well, if all activity, especially retail activity, is moving to layer twos, then all of a sudden people need less ETH to transact. And so maybe the prevalence of layer twos will have a material effect on demand. But I think that there's a few different arguments out there. I definitely think that overall, I think it's going to be a good thing for the price of ETH in the long run.